Hey, welcome back to our channel. My name is James Johnson. I've been a wealth advisor since 2003. My expertise lies in retirement and estate planning. And what I want to talk to you about today is I want to talk to you about Social Security and retirement income. You see, in order to retire, as I've told you before, you have to have one thing, and that's called a paycheck. And most people's paychecks are going to come from known sources, such as Social Security, pension if you're lucky enough to have one, possibly some rental incomes. And then it's going to be made up, the gap's going to be made up from your other assets, as far as your 401ks, IRAs, etc. So just a real quick note about me. I've been a wealth advisor for the last 18 years. I'm a $1 million roundtable, top of the table producer. I'm a master lead advisor for Ed Slott for more than 9 years. An ex-Marine, really no such thing. I'm the president-elect for Irvine Rotary this year. I'm not sure why I did that because I didn't have enough to do already. I'm a father of two, and I have a passion for teaching people about retirement and about money. So some real quick disclosures. I don't work for the Social Security Department or any other government agency. Basically, everything here is hypothetical, illustrative purposes, and actual results will vary, okay? Everybody is an individual, and that's why it's so very, very important that once you get this education, that we sit down and we talk about your situation specifically to your needs. But be sure not to leave this education today or any education we do and run right out and change things because you got it all figured out, because the reality is you're only getting the tip of the iceberg. So our agenda for today is we'll talk about Social Security basics, the consideration for couples, consideration for divorced individuals, consideration for widows, and coordinating with other retirement income streams in order to make sure that you live the lifestyle you've become accustomed to, adjusted for inflation and taxes, out over your life expectancy for you and your spouse, and you don't run out of income. So some important things to consider, and that's the market safety has changed, all right? And I'm not just talking about the stock market here, about how the stock market goes up and down. That's certainly going to play a part in your retirement. But I'm also talking about the long-term treasury rates. Now, the long-term treasury rates are based on the U.S. Treasury. And basically what this boils down to what happens with inflation and what happens with what are called cost of living raises inside of Social Security, and what will that look like going forward. Now, just recently, we got one of the largest cost of living raises that we've ever gotten in Social Security just in this last year. But it's important to understand that many years we don't get a raise at all. And so when we're using an inflation factor inside of Social Security as far as COLA goes, we have a tendency to always overestimate expenses and underestimate growth because you'll be much happier in the end. So a 1.5 is a pretty good COLA factor. Anything above that might be a little optimistic. The question that always comes about Social Security is, will Social Security be there when I get there? Now, I find that funny because back in one of my Ed Slott classes back in Dallas it was a long time ago. It was back in the late 2010, 2008, something like that. A gentleman walked in the door and he stepped up on the stage and he says, folks, I'm willing to bet you, he reached into his pocket like this, and he says, I'm willing to bet you $100 there's not a single person in this room who's read their Social Security statement. Now, ironically enough, I had read my Social Security statement literally the day before. And he says, okay, great. I stood up, I put my $100 up, and he says, okay, great. He says, I want you to tell me what the second paragraph on the first page says. I handed him my $100 and I sat down. And the reason why I did that is because what I didn't realize, as probably you didn't either, because like everybody else, I took my Social Security statement. I opened it up and I read the numbers right there and I read the numbers right there and then I closed it and I filed it. Well, the reality is that on that second paragraph of the first page, it said that without changes, the Social Security system will begin paying out more than it actually collects. And by the year 2040, we'll have to reduce benefits by X. Well, I went right back and I read that, and I read that 6 years prior to that, and I couldn't believe it was actually there. And not only was it there, each year it changed. And you can see here that now they're projecting that it will run out of income somewhere here around 2033, 2035, and that they'll have to cut the benefits by anywhere from 76 to 79% will be the actual amount that they'll pay out in accordance with what they're actually bringing in at this point. So nobody really knows what those numbers are, and those numbers keep getting changed all the time. But what we do know is, and it says right in their Social Security statement, it says without changes, this is what will happen. So what we do know is that without changes, there is going to be cuts in Social Security going forward, but it's more likely that they'll change the rules than that. Now, there was this recent event called the pandemic, and the pandemic has had effects on it. And the reason why is because many people didn't work during that time. They got a lower Social Security wages. And what most people don't understand is that although it takes 40 quarters to qualify for Social Security, it's the last 35 highest years that determine what your Social Security is. So the pandemic had an effect on many people, not to mention the amount of money that went into the Social Security system. So the 2021 trustee report showed that 2034, 2035, 78% of the benefits would be payable. And now it's 2033, 34, 76% of the benefits will be available. And it also shows that there'll need to be an increase of at least 3.36% on Social Security taxes going forward. So that taxes were increased at depletion, it would be a 4.2% would be required for the system to survive. So what I would tell you is that Social Security has changed many times since its original inceptions back in the 30s. Now, back in the 30s, they said Social Security would never be taxed. Yet, as we're going to talk about later on in this presentation, Social Security began to be taxed, or what was called means tested, back in the 80s. Social Security was available to you at a much younger age, and full Social Security was available at a much younger age, but yet that's been changed. Thresholds for when they draw it out has been changed. Many things have been changed. So I would say it's more likely that what they would do is, rather than having a earning threshold of $147,000 where they stop taking Social Security out of your paycheck, that number would be moved up. Rather than having an early retirement age of age 62, that number would be moved up. And we've already moved the full retirement age up from 66, actually 65 to 66, and now 66 to 67. So it's likely that number would be moved up. And it's also highly likely that that increase of 8% out to age 70 would be pushed out to 72, 73, 74. Now, nobody really knows what it means, but what we do know is there will be Social Security changes in the future, certainly before the year 2033, when the whole system is exhausted and we begin paying out less. So payroll taxes are currently 12.4%, which means that they have to be a 3.2. Now, half of that's paid by the employer and half of that's paid by the employee, but we would be looking at rates of like 16% in the future. None of these changes would impact the benefit of people who are currently near retirement. The one that would impact the benefit change would be the consumer index, meaning that the amount that the COLA was on an annual basis. You can see here the impact of that over that period of time. So now what we want to look here at is, what is the difference between taking our Social Security at age 62 and age 70. So at 62, let's say your benefit is $1,125, which is basically 75% of your full retirement benefit. And at 66, if you're young enough, you were born before the year 1960, basically those born between 1943 and 1954, okay, would get age 66, whereas other people, oops, back up here, okay, other people after that age are ramping up. So they're 66 in 1 month, 66 in 2 months, 4 months, 8 months, etc. And most of those are now quickly disappearing because most of them are at full retirement age. So at your full age, which would be age 70, and by the way, it makes no sense whatsoever to ever wait past age 70 to take your Social Security, because between your full retirement age, which is 66 to 67, your Social Security is increasing by a total of 8% per year every year. So you can see your high point here is 1980, 15, 11, 25, and there's a 76% increase over that period of time. Now, if your full retirement age is 67, then your number would be 1,050, it would be 1,500, and it'd only be 1,860. And the full increase over that period of time would be 77%. So, given those numbers, it's hard to say exactly when the best time is to take your Social Security without actually running a comprehensive report, something which you cannot get at the Social Security Department. Now, if benefits are cut, well, what will that look like? So if we look here and we use a life expectancy out here to age 85, then what we find is that even if the benefits are cut by 24% in 2035, then there's about a $36,000 difference between claiming it at 62 and 70 over their lifetime. And here, there's still a difference of about $20,000, $18,000 between 62 and 70. So even if benefits are going to be cut, there's still some arguments for waiting to take your Social Security at its highest point. So about your statement. Now, you'll notice that you haven't gotten statements in a very long time unless you're close to retirement, and then they started sending them to you again. The Social Security Department stopped doing that because they designed a website where you could actually go get that information, and it's ssa.gov. You go out there, you create an account, you put in your password, you do all that stuff, and then you can get your Social Security statement now. This is going to be important for you at the end of this session because you're going to need to go do this. So you might want to write down that information, ssa.gov, and be sure to go set up your account online so you can start getting your Social Security statements again. It's important to understand that those Social Security statements do not show cost of living raises. It's important to understand that they assume that you're going to continue to work out to the point where you grab your benefits. It's also important to understand there's no average wage indexing changes applied, and it's only your record. So if you're married, divorced, surviving spouse, those types of things are not necessarily on that report. And this is why it's so important to get a comprehensive report showing you what your Social Security looks like. Now, there are three things that are major categories of benefits when it comes to Social Security. The first one is retirement. So the second is the spousal benefits. And if you are married or divorced, you may be able to access a spousal benefit, which can be up to 50% of your spouse's or ex-spouse's full retirement age benefit. And upon the first death, the survivor or even a divorced surviving spouse may be able to access a survivor's benefit, which is generally higher of yours or the benefit of the deceased. So we're going to talk about all of that. Now, remember I said that many people think that claiming Social Security at younger age is probably better than claiming it at an older age. Well, the reality is there's a break-even point. And I hear people say all the time, well, I'm going to take it at 62 and then I'm going to bank that money. Well, there's some things that they're not considering, and that's the reduction and the taxes and the cost of living raise. And what I can tell you is this, is there's nothing on the market today that increases by 8% every single year you wait to take it. There's not an annuity. There's nothing out there that can give us a guaranteed 8% increase. So often, waiting to take that is a very beneficial thing to do. And we can show you in these reports at what point you break even. Now, I can't tell you exactly when the best time is for you to take your Social Security, unless, of course, you can tell me the day you're going to die. And if you can tell me the day you're going to die, I swear to you, I can create a plan for you that your last check will bounce, all right? It'll be a wonderful thing. But I suggest you live like you're going to die tomorrow and plan like you're going to live forever, because you see, you just might. Now, the important thing to understand are there are literally hundreds of ways to take your Social Security. And so where the break-even point comes down to is determined by one of those hundreds of ways. There's 9 whole year elections for spouse number 1. There's 9 whole year elections for spouse number 2. And then there's a combination of any one of those choices, and it is literally in the hundreds as far as the number of choices on how you could take your Social Security and at what point the break even is. And in these reports that we're going to run for you, you're going to be able to see very quickly which one of those there are. Now, there's some considerations when it comes to married couples, all right? And it's very important that if you're a married couple that you think hard on who the surviving spouse is going to be before you take your Social Security. That's, of course, if you love them and you want to take care of them out of your entire lifetime. So planning for a survivor is critical, all right? It's very, very important. Think about this before you get started. Survivor generally receives the higher of his or her benefit or the benefit of the deceased. So that's important because you want that person to be getting the most, because what's going to happen is you're going to go from 2 incomes to 1, and you want that to be the highest of the 2. So 80% of women survive their husbands on an average of for 14 years. It is true that married couples live longer than single people. Not sure why that is. And it is also true that married men usually die first. I have a joke about that, but without being able to sit here and discuss it with you, I don't really want to tell you. When we meet in person, ask me why married men always die first. So, 98% of widow benefit recipients are women. You don't believe me? Go down to your local nursing home and see who the residents are. It's mostly women and a whole lot of happy men because they have all these single women. Now, spousal benefits, in order to qualify, you must have been married for at least 1 year. Your primary worker must have filed. Generally, must not qualify for a benefit of your own that is equal to or greater than half of the primary worker's PIA. Up to 50% of your spouse's PIA, not benefit amount. John's PIA, primary insurance amount, at full retirement age is $2,000. Jane's would be half of that. Now, it's important to understand that in order to qualify for Social Security, you have to have 40 quarters. However, in order to qualify for spousal benefits, you simply had to be married for at least 1 year, and you could get up to half of your spouse's benefit without ever paying into Social Security. That's called the spousal benefit. And you can get addition to your own Social Security based on spousal benefits, depending upon what your total benefit is going to be. Now, there's some substantial differences between spousal benefits and the benefit of your own record. Spousal benefits are reduced on a faster schedule than benefits on your own earning record if you elect early. For example, if your full retirement age is 66 and you claim at 63, you will receive 75% of your full benefit. If you take a spousal benefit at 62, you will only receive 70% of your full benefit. Spousal benefits also don't get delayed credits, meaning they're not increasing by 8% every year. Remember, on your own record, you get an additional 8% each year that you delay past full retirement, and that doesn't happen with spousal benefits. Now, here's a case study, and we've got John here, born on 1/2 of 1960. His PIA is $2,500. Planning to age 85. Jane, born on 1/2 of 1965, PIA $1,800, planning to live to be age 90. So as I told you, the women generally live longer, okay? So if we take and we file at the early age, which is 62, and we file at the recommended strategy, it's $1,157,040 as opposed to $964,104. That's a difference of $192,000. So you can see how important, and that's only if they live out to 85 and 90. They live beyond that to 100. It's a much more substantial difference. And so that's the importance of running these reports and actually doing some planning before you take your Social Security. So we go out over here and we can see that the suggested strategy is John takes his at 70 at $3,100 and Jane takes hers at 69 of $2,088. Now, what happens here very frequently is people say, well, if I don't take my Social Security at 65 or 66 or 62, I can't retire and I have to retire. Where am I going to get my income from? Well, that's our job. Our job is to sit down and show you how to design income streams that are guaranteed that you can outlive over your lifetime and fill in that gap so that you can extend your Social Security all the way out. Now, for some of you, that's not going to be able to happen. And remember what I said. This is a case-by-case basis. So what you're going to want to do is you're going to want to be asking us, the advisor, what if we die at this age? Well, I'm actually going to be able to show you that in your Social Security report. And I'm actually going to go down here and say, well, okay, John's only going to live to be age 80, but Jane's going to live out here to be age 90. And I'm going to be able to show you on this chart exactly what your numbers would look like over that period of time if you were to wait. And this line, this red and this blue line here, is the break-even line. So that's the point where it makes more sense to take the suggested strategy than the earliest strategy. What if we need cash flow sooner? Well, that's what I was talking about. So that means that we might want to design a little bit different plan, all right? So we throw another strategy inside of here about taking it earlier. Or we go over to our other assets and we design an income stream that'll actually get us to that point. So we can see here now that we have three strategies, the recommended strategy, the split strategy, and the earliest strategy. And all of them are better than the earliest strategy, and we could come up with 4 or 5 strategies if we wanted to. So the alternate strategy says that John takes his at 70, Jane takes hers at 62, and you can see over here now, this green strategy, we can see the break-even points on where that happens, okay? So the red's over here, here's the green, and then we kick into the blue. Now, the thing is that a lot of people think, well, I'm going to take my Social Security at 62, but what they don't understand is that there are reductions for taking your Social Security too early. And so what happens is that if you take your Social Security too early, then it gets means tested. So that means that if you have earned income, and that's W-2 income or any self-employment income that exceeds $19,560, your Social Security is going to be reduced. Meaning that every $2 over that, your Social Security is reduced by 1. So let's just say, for the sake of argument, that your Social Security was $2,000 a month at age 62. $2,000 a month at age 62 would be $24,000 a year. If you double that 2 to 1, that's $48,000. So if your income was $48,000 above the $19,560, your Social Security check would be zero. And you would have locked that in because you'd be what's called deemed filing. You would have locked in your lowest rate ever. You wouldn't be getting any increases other than cost of living raises on your Social Security for the rest of your life. So in most people's cases, it does not make sense to take Social Security prior to full retirement. And the reason why is because this is a sliding scale. So up to age 67, at age 67, you can have an earnings of $51,560 right up until the month you turn 67 and not have any reductions in your Social Security. This is also true for the 66 years old, whatever your full retirement age is. By that time, it's a 3 to 1. So meaning that you can make considerably more money and be reduced on a 3 to 1 scale. And at full retirement, you could be making $3 million, $30 million a year, and it's going to have no effect on your Social Security from a standpoint of reduction. It still will have effect on taxes, which we'll look at soon. So during the year which you reach full retirement age, you can earn up to $51,560 the year before the month you reach full retirement age without any withholding. If you make more than $51,560 before the month of full retirement age, then $1 for every $3 withholding takes effect the income earned prior to the reaching FRA age. So, some considerations for widows and widowers. So, qualifications is you have to be widowed, all right? You have to be at least 60 years old. You have to remain unmarried until after age 60. You were married for a minimum of 9 months prior to death, and some special exceptions do apply. So, widow benefits work like this. A widow benefit is based on when the deceased filed and when the survivor files. Straight line reductions of 28.5 divided by the number of months to the widower's full retirement age. If the deceased did not file for benefits before they passed, then you would be eligible for either the full retirement age benefit plus any delayed retirement credits, and they may have been eligible for it if they had claimed on the date of death. If the deceased filed, you are limited to the higher of what the deceased was receiving, or 82.5% of the deceased full retirement age benefit. The most important thing to know about widow benefits is that you can switch between widow benefits and your earned based on your own work history. If you file for spousal benefits prior to full retirement age, you cannot switch. If you file for widow benefits, you can switch over to your full retirement age later on down the road at, say, 67 or 66 or 70, depending upon when you chose to do it. Example, at age 60 is 71.5% of the primary insurance amount at full retirement age, and you can switch between widow and retirement benefit. That's important. So here's a widow case study. John never elected and died at age 60. His benefit at age 67 would have been $2,000. Jane is now 60. Jane's benefit on her own earnings would be $1,200. So what should Jane do? Well, one thing Jane could do is she could just go file without thinking, okay? But I always suggest that you do take the time, let's go run a report, because see, the Social Security Department is not going to do this. Social Security Department is going to show you what your highest thing is today, not what your highest would be over a period of time. So you could file for widow benefits at age 60. SSA will help you with Medicare filing. Now, they may or may not do that, okay? So if you go out here, you switch to your own benefit when she files for Medicare, if she was smart enough to do that. Okay. Strategy one would be this. You file for only widow at age 60, switch to her delayed retirement credits at age 70. Strategy two would be file for your own retirement at age 62 and switch to widow benefits at 66 and 8 months. Now, in this particular case, it might be 67, depending upon whether that's your full retirement age. So what does that look like? Well, if we just do it without thinking, we get about $514,800 over our lifetime. If we do it based on the Medicare scenario, we would get $564,900. If we use strategy one, we'd get $681,600, and strategy two, we'd get $627,200. So as you can see, by doing a little bit of planning, it could be a substantial number. The number between file without thinking and the strategy number one is about $165,000 difference, about $167,000 difference over that period of time. That's a considerable number out of your life expectancy. So then we have considerations for divorced individuals. So divorced individuals must have been married for a continuous period of 10 years. That means that if you were married for 5, got divorced for 2, and got remarried for 5, you do not qualify. It must have been 10 years continuously. You must not be currently married. Same benefits amount and reductions apply for early claiming as a current spouse. So remember, you're going to have those income limitations for filing before full retirement age. You must be independently entitled, meaning you have to be 62 years or older, or divorced for 2+ years. So, 10 or more years of marriage for surviving divorced spouse, must be unmarried unless remarried after reaching age of 60. Benefit amount is the same as the surviving spouse. So, given those choices, you've really got to run the reports. There's a lot of options here on how this can be done, but you really need to run the reports and know exactly how these rules apply to you if you're divorced or a surviving spouse. It's important to understand that it doesn't impact your ex. It doesn't affect a current spouse or any other dependents. And the ex is not notified by the SSA that you are claiming under their record. Quite frankly, it's none of their business. So I want to show you the difference here in what happens if you elect your Social Security early, okay, as opposed to electing your Social Security late. So you can see here, in the case of a surviving benefit, John's benefit over here is the blue one, and Jane's benefit over here is the black one. And so they both file at their youngest ages here. And then John gets out here and John dies. And so now Jane gets merely the surviving benefit. Okay, so she gets the highest of the two. She gets the surviving benefit. And you can see that their need, which is this line up here, is what they actually need to live on. And they say that the need drops considerably here at this point right here. But, you know, the reality is that this is not necessarily going to drop that much because John just didn't eat that much. The bills are pretty much the same going across the board. So there's a little bit of a fallacy there. I think that most people's expenses change very little, but their income changes dramatically upon one person's death. And then she gets out here and she lives this long. Now, if we delayed that credit and we didn't start taking that credit out here until their full retirement ages, you can see we kind of close the gap with the Social Security, and we have less of a gap over here, but now we have a gap. I'm sorry, we close the gap here. We have less of a gap over here. And over here now, in this area right here, we have a gap that we need to make up for those years between 62 and 66 or 67, whatever their full retirement age is. Now, the way we do that is we make up for those with other known incomes, possibly rents, pensions, and or assets such as our 401ks, IRAs, annuities, brokerage accounts, whatever the case may be. Now, one of the things that most people are not aware of when it comes to Social Security is that back in the 80s, we began to means test Social Security. Meaning that if you've done, I know in the 30s they said they were never going to tax it again because it was a tax, but you know what? Things change. And the reality is that the government depleted the fund. And so in order for the fund to go on, they had to tax the fund going forward. So now they use something called provisional income. And what provisional income is it's for starters, it's 50% of your Social Security. Any ordinary incomes, dividends, capital gains, non-taxable interest, distributions from 401ks, IRAs, 403bs, 457s, etc. Any income that would end up in your AGI. Now, based on that AGI, if your adjusted gross income over that period of time for a single person is over $25,000 or for a married person is over $32,000, up to 50% of your Social Security is taxable. So if you're getting $10,000 with a Social Security, $5,000 of it's subject to taxes. Up to $34,000 on single and $44,000 on married. Up to 85% of your Social Security is taxable. If you're getting $10,000, $8,500 of it's subject to taxes on those different thresholds. So the important thing to understand about this is that these laws haven't changed since 1985, and therefore every year more and more people are becoming subject to Social Security taxes because of the fact that inflation is having them have a higher AGI just to survive. So some tax examples of that would be this. If they're making $40,000 in Social Security with a $20,000 IRA withdrawal right here, that means that their provisional income is $40,000. So in the single class, $8,000 of that is above the 32. And so they have a 10% tax on $4,000 of their taxes. At $20,000 Social Security and $40,000 IRA withdrawal, they have $50,000 with provisional. So down here, they have $18,000 above over here, and $6,000 above that $50,000 threshold. So they're getting taxed over here on $11,100 where the benefits are being subject to taxes. Now, there's something called restrict application where you may get more. And so this only applies to people who were born before January 1 of 1954, okay? So if you weren't born before January 1 of 1954, this is going to have no effect on your Social Security. This is not going to be a concept that you get to use, okay? But if you were born before 1 of 1954, then you have an option of doing this. Let me get this mouse where it's supposed to go. Okay. Then you have an option of doing this restrict application where you file for only spousal benefits while allowing your retirement benefit to grow with delayed retirement. It's very similar to the case we discussed with the widow's benefits, but applies to spousal, divorced spousal, and retirement benefits. Here are just a few examples, okay? Now, keep in mind that if you weren't born before that magical date, it isn't going to matter. So the married couples claim your own and then add spousal, and claim your spousal and then switch to your own. Divorced individuals, same options, but X's actions are irrelevant, independently entitled. So you want more? Well, basically, here's how it works. If you use a recommended strategy on this suspension, the file and spend, then your recommended strategy give you $1.1 million, and the other one will give you $996,000, living out to age 85 and age 90. So what is the suggested strategy? Well, Jane files for the benefits at 63, which is $1,205. John files for a restricted application for only spouse benefits based on Jane's earnings records, where at 66 years old receives $769 a month, then allows John to continue to earn delayed retirement credits on his own benefit. John switches to his own retirement benefit at age 70, receiving $3,751 a month. Now, as of that act of 2015, it eliminated file and suspend strategy. So this is really simple. If you weren't born before January 2nd of 1954, you don't get this strategy. It's gone. So it was a great strategy, but for most people, it's gone. If you're on here and you actually are of that age, it is a strategy we could talk about. So what if I went out and I've already filed? I went out here and I put together my Social Security, and then I came to this seminar and I realized that, oops, maybe there was a better way, okay? Well, the government actually gives you a do-over. Now, if you filed prior to 66 or your full retirement age, you can go out here and you can actually file a 521 form, pay back all the Social Security that you've received, and go back into deferral. Now, if you're over age 66 or full retirement age, then literally you can just go and suspend your Social Security and go back to that. But if you filed under your full retirement age, you have the do-over clause. So why don't we go and we talk to the Social Security Administration about this for advice? Well, SSA looks to get the highest monthly benefit on the day you file. SSA cannot give you advice. SSA cannot coordinate benefits with your outside assets. And that's probably the most important thing to understand here, that one of the biggest mistakes that people make is they take their Social Security early because they merely don't understand that they have other choices. So what's the value of sitting down and talking with a wealth advisor, someone like me? Well, that's pretty simple. I can provide you with a Social Security analysis report. And at the end, I'm going to show you how to go and get that report right away and have all of these decisions and be able to look at all those hundreds of ways that you could be able to do it and figure out which one works best for you. Not only can I do that, I can provide you with a retirement income analysis and helping you figure out where you are financially, where you're going financially, show you how to live the lifestyle you become accustomed to, adjusted for inflation and taxes, and not run out of income over your lifetimes. It's pretty valuable stuff. It'll help you sleep a lot better at night. And I'll show you how to fill the gaps. How do you fill the gap between your known incomes and your needs? And we'll give you a comprehensive retirement income plan that you'll be able to sleep well with at night and help you to figure out how to solve these problems. And remember this statement: good, better, best. Never let it rest till good gets better and better gets best. Because I can assure you that everything you've done up to this point has been good. But maybe there's some better ways or even some best ways in order to do it, and figure out how you can actually go into retirement with a peace of mind that you won't outlive your money. So what now? Well, you can go out and get your Social Security report. Normally that would cost you $29. And you would go to our website, you'd go on there, you'd pay your $29, and then you'd have an appointment with me and I would show you that. But because you took the time to watch this webinar today, you are going to get that appointment and that report for free and no obligation, no sales, none of that kind of stuff. And we're going to sit down and we're going to run that report for you and give it to you, literally hand it to you, so that you'll know what's going on in your Social Security and much more. But in order to do that, you are going to have to go out to ssa.gov and go get your account and go get your Social Security statement for you and your spouse. Please don't come to that appointment without it, because really of no use. I can't do it with guessing. If you want guessing, go to the Social Security Department. If you want some accurate information, you got to bring me those reports so that I can do that. Now, if you have a pension, then we didn't talk about that inside of here, but there's what are called WEPs that will reduce the amount of money you'll get on Social Security, and a pension is very, very important information. If you have that as well, we're going to want to put that in there and figure that out. So if you work for any kind of government agency and you have a pension, such as a teacher, the state, the city, the feds, you're going to want to have your pension information when we do that as well. Now, in order to do that, literally all you have to do is right now, take your phone, go over here and take a picture of this scan code right here. And that's going to take you out to this website, which is Calendly. And you're going to be able to go in there and figure out what time works for you inside of my schedule and schedule a time to meet. But be sure that when you come to that meeting, you have your Social Security reports. And if you can get them to me before then, that would be great because I can get the work done before then. If you are going to want to know more about your retirement and you're going to want to see a full financial report about where you are retirement-wise, be sure to have your Social Security statements, your tax returns, any financial statements, possibly payroll statements, those types of things, and have some idea so we can start drilling down where you're at on that. Be sure to visit our website at www.yoursafemoneypeople.com for more education. And be sure to subscribe to our YouTube channel below so that you can get notified when we put out these videos. We put them out pretty much weekly. Now, all I could tell you about this is that probably the most important thing I could tell you is this, is live like you're going to die tomorrow. Plan like you're going to live forever because you just might. And be sure to take the time to get this planning done. Because see, what I can tell you is the two biggest mistakes that people make with regards to retirement and estate planning are this. Number one is procrastination. It's the number one thing. They put it off, they put it off, they put it off. The number two thing is that they don't do any planning. They don't plan to fail, they fail to plan. I know that sounds really cliche, but believe me, the sooner you can do this, the better off you're going to be and the better you're going to sleep at night. So remember, go subscribe to our YouTube channel, keep smiling, and I look forward to seeing you on the next one. Make it a great day.